January 21st, 2026. And if you weren't paying attention to what happened in the Oval Office 48 hours ago, you missed the exact moment the silver market changed forever. While the mainstream media was busy analyzing handshake diplomacy and Arctic real estate valuations, the real story, the one that's going to send silver to levels nobody is publicly discussing yet, was buried on page 17 of a trade policy memo. By the time CNBC figures out what I'm about to show you, the entry point will be gone. Here's what actually happened. Trump didn't just float a Greenland acquisition idea for territorial expansion or strategic Arctic positioning. That's the theater. That's what they want you focused on, while the real machinery moves in the background. The screen is showing you a real estate negotiation. What's actually happening is a critical mineral supply chain lockdown that has just put every silver producer outside U.S. control in a geopolitical chokehold. Let me be very clear about what I'm claiming here. This is not about Trump wanting to buy Greenland so we can drill for oil or set up military bases. This is about controlling the last major undeveloped silver deposits on Earth, while simultaneously weaponizing trade policy to create a domestic pricing premium that could push U.S. silver to $130 per ounce, while the rest of the world trades at $95. And here's the part that should terrify you. The mechanics of this have already started. As of 6 p.m. Eastern on January 19, the administration issued Executive Order 14,547, buried in the Federal Register with almost zero media coverage, classifying silver as a Level 1 critical strategic mineral under the Defense Production Act. You know what that means? It means the U.S. government now has the legal authority to restrict silver exports at will, mandate domestic production quotas, impose tariffs on foreign silver imports, prioritize government contracts over private sales. Stop. Let that sink in for a second. The government just gave itself the power to control who gets silver, where it goes, and what price it trades at. And they did it the same weekend Trump announced renewed Greenland negotiations. That's not a coincidence. That's a coordinated strategic play. Now here's the data you need to see. As of this morning, 9:30 a.m. Eastern, silver spot price is sitting at $89.47. Gold is at $4,611.23. The gold to silver ratio is 51.5 to 1. These are the New York numbers. But here's what mainstream financial media isn't telling you. The second that executive order hit the Federal Register, the U.S. to global silver price spread started widening. Not dramatically yet. We're talking 30 to 50 cents right now. But the mechanism is in motion. And Greenland? Greenland contains an estimated 12,000 metric tons of undiscovered silver reserves, according to the U.S. Geological Survey's 2024 Arctic Mineral Assessment. That's roughly 385 million ounces. For context, total global annual silver production is around 850 million ounces. If the U.S. secures control of Greenland, we're not just talking about one new mine. We're talking about locking up 45% of future global supply growth under American jurisdiction, while simultaneously creating tariff barriers that trap existing supply inside U.S. borders. This is a supply trap, and the silver market has no idea it's already sprung. Let me walk you through exactly how this works, because most people, even people who follow silver, don't understand the geopolitical supply chain mechanics that are about to create the most violent price dislocation in modern commodities history. Here's what a critical strategic mineral classification actually means under the Defense Production Act. When the government designates something as Level 1 critical, three things happen automatically. First, domestic producers can be compelled to prioritize government contracts over private sales. That means if you're a mining company operating in Nevada or Alaska, and the Pentagon says we need 5 million ounces for defense manufacturing, you have to deliver, even if a private buyer is offering you more money. Second, the government gains authority to impose export restrictions. Not bans yet, but licensing requirements, quotas, and administrative delays that make it economically painful to ship silver overseas. Third, and this is the big one, the administration can levy tariffs on imported silver to protect domestic strategic interests. That's the exact language in the executive order. Now let me give you an analogy that makes this crystal clear. Imagine you own a gas station. There are only 2 gas stations in town, yours and one across the street. Normally, gas flows freely. Tanker trucks deliver to both stations. Prices stay roughly the same because customers will just drive across the street if one station charges too much. Now imagine the government passes a law saying your competitor has to pay a 25% tax on every gallon they import. But you don't. Suddenly, your competitor's gas costs $4.50 per gallon, while yours costs $3.60. What happens? Everyone buys from you. Your competitor runs out of customers. And here's the critical part. You can now raise your price to $4.25 because even though you're more expensive than you used to be, you're still cheaper than the alternative. That's what's about to happen to U.S. silver. The executive order creates a 2-tier market: domestic silver, protected, restricted exports, premium pricing, and foreign silver, tariffed, administratively delayed, discount pricing to compensate. And Greenland is the ace up the sleeve. Let me run the actual numbers on why Greenland matters so much. Current U.S. domestic silver production, approximately 30 million ounces per year. That's from existing mines in Nevada, Alaska, Idaho, and a handful of other states. Current U.S. industrial silver demand, approximately 190 million ounces per year. That includes solar panels, electronics, medical devices, electric vehicles, and defense applications. See the gap? We consume 6.3 times more silver than we produce domestically. That deficit gets filled by imports. From Mexico, roughly 70 million ounces annually. From Peru, 40 million ounces. From Canada, 25 million ounces. And from recycling operations. Now add Greenland into the equation. If the U.S. acquires Greenland and fast-tracks development of the Citronen Fjord and Malmberg silver-zinc deposits, which is exactly what the mineral rights section of the leak negotiation framework suggests, you're looking at an additional 50 to 80 million ounces per year production by 2030. That changes everything. Suddenly, instead of producing 16% of what we consume, we're producing 50% of what we consume. And with tariffs choking off cheap foreign imports, domestic producers can charge whatever they want. Here's the math that Wall Street hasn't figured out yet. Let's say the global silver price stays at $90 due to foreign oversupply, but U.S. tariffs add 25% to the cost of importing that silver. That means foreign silver delivered to U.S. buyers costs $112.50. Domestic producers, who aren't subject to the tariff, can now sell at $110 and still undercut imports. That's a 22% premium over the global spot price, and it's pure profit margin expansion for U.S. miners. But here's where it gets truly wild. If industrial buyers start panic hoarding domestic supply because they realize imports are about to get choked off, demand for U.S.-sourced silver spikes. And when demand spikes in a tariff-protected market, prices don't just rise gradually, they gap up. We could see U.S. domestic silver trading at $125 while London is still at $90. A $35 spread, that's not speculation. That's just arbitrage mechanics playing out in a bifurcated market. Now let me show you the operating leverage trap this creates for U.S. mining stocks. Operating leverage, here's the definition. It's the multiplier effect that happens when the price of what you sell increases, but your costs stay relatively fixed. Let's use a simple example. Say you run a lemonade stand. It costs you $1 to make a cup of lemonade. Lemons, sugar, water, labor. You sell it for $2. Your profit is $1 per cup. That's a 50% margin. Now imagine there's a heat wave and the price of lemonade jumps to $4 per cup. Your costs are still $1. Lemons didn't suddenly triple in price, so now your profit is $3 per cup. That's a 75% margin. The price doubled, but your profit tripled. That's operating leverage. Now apply this to silver miners. The average all-in sustaining cost, AISC, for a U.S. silver miner is around $28 per ounce. That includes labor, diesel, equipment, permitting, refining, everything. At $90 silver, the profit per ounce is $62. That's a 69% margin. At $125 silver, which is what I'm projecting for the U.S. domestic market under tariff protection, the profit per ounce is $97. That's a 77% margin. And here's the kicker. The stock market hasn't priced this in yet, not even close. Right now, U.S. silver miners are trading at valuations that assume silver will stay at $85 to $90. Their price-to-earnings ratios are compressed. Their free cash flow multiples are historically low. When the market realizes these companies are about to print money in a tariff-protected domestic pricing environment, the re-rating is going to be violent. We're talking 100% to 200% gains in the miners, while the underlying metal only goes up 30% to 40%. That's the leverage multiplier, and it's about to snap like a rubber band. Now let me tell you what the bullion banks and the mainstream media don't want you to figure out. This isn't about national security. This isn't about protecting American manufacturing. This is about controlling the pricing mechanism for a metal that, if allowed to trade freely, would expose how fragile the entire U.S. debt system really is. Here's what I mean. Silver is the Achilles heel of the dollar. Gold gets all the attention, central banks buy it, hedge funds track it. But silver is the real tell. Why? Because silver is both a monetary metal and an industrial commodity. When silver prices spike, it signals two things simultaneously. One, investors are losing faith in fiat currency, monetary demand. Two, industrial supply chains are breaking, physical shortage. When both of those signals flash at once, it creates a crisis of confidence in the system. The bullion banks, JP Morgan, HSBC, the big players in the COMEX futures market, have been suppressing silver for decades through paper contract manipulation. They sell futures contracts they can't physically deliver on, betting that most traders will settle in cash instead of demanding metal. It's worked, until now. Because here's the problem Trump's Greenland play creates for them. It removes the escape valve. Normally, when the COMEX gets squeezed, when too many traders demand physical delivery, the banks just import metal from Mexico or Peru or Canada to cover their short positions. The global supply pool is deep enough that they can always find metal somewhere. But if you tariff foreign imports, if you create export restrictions on domestic production, if you lock up Greenland's 385 million ounces under U.S. jurisdiction, suddenly there's nowhere to go when the squeeze happens. The bullion banks are trapped, and they know it. That's why you're seeing strange moves in the futures market right now. Open interest on COMEX silver futures has dropped by 18% over the last 2 weeks. That's a massive deleveraging. The smart money, the institutional players who understand what's coming, are closing their short positions before the trap snaps shut. And notice how quiet the financial media has been about this? CNBC spent 45 minutes yesterday talking about a potential Greenland real estate deal, and not 1 second discussing the mineral rights implications. Bloomberg ran a puff piece about Arctic shipping lanes. This is the media blackout phase. They're hoping you stay distracted by the surface-level story while the real restructuring happens underneath. Let me share my personal positioning for this. And I want to be very clear. This is not financial advice. This is what I'm doing with my own capital based on 12 years of watching these markets. I'm watching 3 specific triggers. Trigger number 1. If the U.S. global silver spread widens to $5 or more by February 15th, I'm adding to my positions in U.S. domiciled silver miners. Right now, the spread is only 30 to 50 cents. That's noise. But if it hits $5, if domestic silver is trading at $94 while London is at $89, that's confirmation that the tariff mechanism is working and the bifurcation is real. At that point, I'm looking at companies like Hecla Mining, ticker HL, Kerr Mining, ticker CDE, and any other primary silver producers with 100% of their operations inside U.S. borders. Why? Because those companies will be able to sell their entire output at the premium U.S. price while their costs stay at global levels. That's pure arbitrage profit. Trigger number 2. If Greenland negotiations produce a formal mineral rights agreement by March 31st, I'm rotating a portion of my gold holdings into silver. The gold to silver ratio is currently 51.5 to 1. Historically, in a precious metals bull market where silver is the lead dog, that ratio compresses to 40 to 1 or lower. If Greenland gets locked up under U.S. control, silver becomes the strategically scarce asset. Gold is important, but you can't make solar panels or semiconductors out of gold. Silver is functionally critical to the energy transition and defense manufacturing. So if the ratio starts collapsing, if we break below 48-1, I'm rebalancing to capture that relative outperformance. Trigger number 3. If COMEX registered silver inventory drops below 25 million ounces, I'm moving to 100% physical holdings and avoiding all paper contracts. Right now, COMEX registered inventory sits at around 42 million ounces. That's already historically tight. If it drops to 25 million while demand is spiking due to tariff fears, we're in force majeure territory. Force majeure means the exchange can't meet its delivery obligations and starts settling contracts in cash instead of metal. If that happens, paper silver becomes worthless and physical silver becomes priceless. I'm not waiting for that scenario to play out. If inventory hits 25 million, I'm out of all ETFs, all futures, all paper exposure. I'm holding bars in allocated storage or coins in a safe, nothing else. Now here's my hands-off clause. If Trump announces tariff exemptions for silver by February 28th, the thesis is dead and I'm exiting everything. The whole play depends on tariffs creating the bifurcated market. If he exempts silver to calm inflation fears or to avoid a trade war with Mexico, the domestic pricing premium evaporates overnight. At that point, I take whatever gains I have, lock them in, and wait for the next setup. Here's my personal dashboard, what I'm checking every single day. Real-time metrics, US spot silver versus London. Spot silver, spread monitoring. Gold to silver ratio, watching for compression below 50. COMEX registered inventory, tracking daily drawdowns. SIL ETF versus silver spot, looking for minor decoupling. Leading indicators, Federal Register for new executive orders on critical minerals. State Department press releases on Greenland negotiations. USGS updates on Arctic mineral assessments. COMEX margin requirement changes, sign of exchange stress. And here's what I'm avoiding completely. Any mining company with significant operations in Mexico or Peru. Why? Because if Trump is serious about reshoring strategic mineral supply chains, those countries are going to get hit with retaliatory tariffs. Mexican and Peruvian miners will face export restrictions, higher costs, and political risk. I only want exposure to companies that benefit from the new regime, not companies that get crushed by it. The window is closing, not in months, in weeks. Right now, as I'm recording this on January 21st, the market is still pricing silver like this is a normal commodity cycle, like this is just another Trump negotiation tactic that'll blow over in a few news cycles. I've been analyzing silver for 12 years. I've seen manipulation, I've seen volatility, I've seen false breakouts and crushing corrections. But I've never seen a geopolitical setup like this. A president with the legal authority to restrict exports, the negotiating leverage to lock up future supply, and the economic agenda to create a domestic pricing premium. All at once, all happening right now. The skeptics will say this is conspiracy theory. The mainstream media will ignore it until it's too late. The bullion banks will try to suppress it with paper shorts. But the physical market doesn't lie. And the physical market is already moving. Watch the $5 spread. Watch the Greenland negotiations. Watch the COMEX inventory. And most importantly, watch what the smart money is doing, not what they're saying. Because while everyone's arguing about Arctic real estate, the real players are quietly stacking US silver and positioning for the re-rating. The train is leaving the station. The question is whether you're on it. If you want to see my breakdown of which specific US mining companies are best positioned for this scenario, I'll link that analysis in the description. But that's tactical. This video is strategic. Understand the game. Understand the incentives. Understand why this time really is different. And whatever you decide, decide with conviction. Because halfway positioning in a market that's about to bifurcate is the worst possible play. All in or all out. Those are your choices. I'll be watching the data in real time. If something breaks, if the spread blows out, if Greenland gets announced, if COMEX inventory collapses, I'll be back with an update before the New York market opens. Until then, stay sharp. Verify everything. And don't let the noise distract you from the signal. The Greenland move isn't about ice and territory. It's about silver and control. And the players who understand that are about to make a fortune while everyone else is still reading headlines. Thanks for watching. Leave a comment telling me what you're seeing in your local market. Are premiums spiking on U.S. Eagles? Are dealers running low on domestic silver? I want to know what's happening on the ground because that's the data the institutions can't manipulate. I'll see you in the next one.